Market value approach has a completely different perspective. It is based on evaluation of comparable companies and applying these findings to the company that is a subject of valuation. Simply said, company is much more than a set of its assets. Brands, employees, industry, and other specifics have to be taken into consideration in parallel with investors' willingness to put their money in. An assets-based approach just cannot cover all of these. At the essence, there are two approaches how this can be done. Looking at multiples for relevant companies listed at stock exchanges and by looking at multiples from relevant M&A transactions. Looking at multiples for relevant companies listed at stock exchange. This is the fastest and easiest approach since you can go at a local or relevant regional stock exchange and see how comparable companies are traded. When we say looking how comparable companies are traded, we mean looking at different multiples or ratios like PE, EV to EBITDA, EV to revenues, and similar as presented below. Have in mind that we can use multiples to calculate either equity or enterprise value or EV by multiplying the selected fundamental value with the appropriate ratio. Enterprise value is the value relevant for the entire company, while equity value is enterprise value minus net debt, or that is the value of all the shares of the owners. Looking at multiples from relevant M&A transactions. This is the same logic, but instead of going to stock exchange, we are looking for recent M&A deals. Simply said, how companies are traded at stock exchanges is relevant for small volumes or stakes, while M&A transactions include controlling premium. This valuation method is very similar in nature. If the relevant multiple is 6.9 times EBITDA and our company has EBITDA at 13.6 million, that means that estimated enterprise value is 93.6 million. If the company has net debt at 65.2 million, equity value will be estimated at 28.3 million, meaning 93.6 minus 65.2 with roundings. Depending on industry, some multiples will be more or less relevant. For example, banking industry uses price to book as the primary and price to assets as a secondary multiple. Companies are usually looking at EV to EBITDA as the primary and EV to sales as secondary. Yet, in retail, price per SQM or per shop is also very important. In oil or mining industries, value per ton might be very relevant as well. Multiples targeting equity value like PE are also very important, but M&A deals are focused at entire business, giving enterprise value more relevance. In addition, companies might have different capital structures, meaning debt to equity ratio, and that is why enterprise value gives us a more consistent view on values between the companies. Have in mind that finding relevant multiples might be time consuming. For most of the deals, public data are not available. For those that you can find information, it's usually just a fraction or a piece of information, so you have to create a puzzle for yourself, meaning to go at the company website and find entire financial statements and recalculate all relevant multiples. For example, you can find that the company is sold for 200 million for 60% stake, or for some other company at 7 times EBITDA, but all other information are missing. Next issue refers to being comparable company. It's not enough to be from your industry. It should be of similar size, similar sales structure, similar region, etc. That is why you should have at least few companies, the more the better, and discuss it with potential buyer about the most appropriate multiple value, or to use the average or even median value in order to eliminate extreme values.